Welcome to the latest edition of Fitch's Virtual Investor Series. I'm John Bella, Managing Director on Fitch's ABS team. Today I'm joined by Ian Rasmussen, a Managing Director, and Margaret Rowe, a Senior Director on our ABS team. We are going to discuss the state of the consumer. A good portion of our investor dialogue over the last year or so has tended to still be pandemic related. Overall, we observed that the consumer held up fairly well. Of course, significant support schemes were in place to help boost this performance. So more recently, as the support has rolled away, our investor conversations have tended to focus on looking for potential cracks across the rated portfolio. Mostly, we're focused on non-prime and subprime borrowers in that regard. Today it feels like we're in a different position. Inflation and interest rates are rapidly increasing. Global GDP is falling. Our Fitch's revised GEO recently published is now predicting the U.S. will enter a mild recession in 2023. Interestingly, some positive offsets to that, our unemployment forecast remains relatively robust. And recent oil price trends, which certainly filter through to the gas prices at the pump, are offering some counterbalance to these other negative variables, perhaps suggesting the consumer is more resilient than we might think. So with that backdrop, we'd like to discuss the state of the consumer. We will begin discussing some performance trends. So Ian, let's start with you. How do you see the shifting economy impacting the U.S. consumer?
Thanks, John. You're right in that this is a very interesting time to be looking at consumer loan performance. I want to start by talking about credit cards, which is a bellwether for consumer credit and being able to monitor and understand consumer credit. What we've seen up to this point really is exceptionally strong performance. We can't forget about the pandemic because I think some of the support that was given during the pandemic is still bearing fruit as we get into more turbulent conditions. But in the case of prime card ABS, for instance, we've seen very strong performance. Monthly payment rates have tended to increase to 40% from 30% before the pandemic. We've seen even in the retail credit card programs continually higher MPRs, plateauing, but still higher than pre-pandemic. And the credit story, delinquencies, charge-offs have remained very low. So what does this mean? What we're expecting now for credit card ABS is that we will have more strength heading into the end of the year than what we were initially expecting. And to your point earlier about unemployment, we think for these portfolios that an unemployment stress will be a meaningful change in the way that these portfolios will perform in the future. Now, one thing I want to mention is that credit card ABS is different than the broader credit card market because these trusts they have aged accounts, there hasn't been new account additions, particularly in the prime bank portfolios. And so we're expecting a divergence in the headlines that we're hearing about consumer credit and some of the problems and what we're seeing in the prime trusts and their performance. Now that will be different for the subprime, non-prime, lower income households, but we can get into that discussion a little later.
Great. Margaret, let's go to autos because I think that makes an interesting transition because I feel we're seeing some of the same things. Headlines are all going to be relatively negative. Underlying performance, depending on which part of the auto subsectors we're talking about, has been more resilient. Can you share some key performance trends that you're seeing in the auto space?
Sure. In the auto sector, since mid-2020, we have seen benefits from a lot of the same items boosting the consumer that have already been discussed today. So early in the pandemic, it was payment relief measures, followed by government stimulus, then a faster than expected recovery, and higher savings rates. So that all propped delinquency and default performance. There were some items that were then a little bit more specific to the auto space, so things like just utility of the vehicle. You may not be using your car to get to work, but you needed it for just about everything else, including what often felt like a safer way to travel. We saw a reduction in mass transit ridership in the urban areas. So this really resulted in what was in many cases record low levels of delinquencies and defaults. As government stimulus broadly ran off a year ago, we have seen incremental monthly increases in delinquencies and defaults. And then we observed some of the kind of typical seasonal trends with heading into the warmer months, performance coming down a little bit, particularly around tax time. But recent months, again, have seen increases, particularly in subprime. So we're watching that closely. The lower income, lower FICO, hourly wage earner borrower cohort is just no doubt going to be more vulnerable to the effects of today's macro trends than their prime counterparts.
The wholesale value, the vehicle value market, and that side of the equation and story is interesting. Can you share where you see the trajectory or expectations for that normalizing in 2023?
Yeah, we have seen some improvement in production. One way that we can monitor inventory on dealer lots is days supply, which while increasing are still currently at about 30 days compared to in the 60s and 70s in 2019. There's just proven to be no quick fix to chip shortages, and it's been further exacerbated by Russia's war in Ukraine. We maintain regular dialogue with OEMs and other market participants, and most seem to agree that at a bare minimum through the rest of this year and likely well into next year, with some even saying 2024 is when used values will normalize. But they are going down. There's just a significant runway between where we are now and a reduction that could negatively affect auto ABS performance.
Great. Yeah, it's incredible to see how OEMs, every time we talk to them, they push back their normalization guesswork into like 6-month increments further and further back. So remains to be seen. Let's stay in the auto space though and do a little bit deeper dive on subprime auto. Obviously, we're seeing some weakness in that part of the market currently. However, we know it's a relatively meaningful part of the overall ABS issuance story. Can you share some key characteristics that you look to see when you're assessing whether and why we would rate a subprime transaction?
Sure, yeah. Fitch has been and expects to continue to be selective in the subprime space. The transactions that we're comfortable rating up to AAA are those from well-established sponsors with robust historical performance data, proven underwriting systems and models. We like to see executive management teams that are cohesive and have, industry experience. We look at things like regulatory compliance, ownership structure, reliance on ABS as a form of funding, and then of course just the absolute levels of default. So the space continues to be fragmented, which can lead to some questionable underwriting decisions in an effort to vie for market share, and in rarer cases, even fraud, like we saw with the now defunct Honor Finance.
Yeah.
So, but it's a broad spectrum of players and at least a handful that we're comfortable with. So I think you can expect to hear more from us in subprime as it comes further into focus with today's macro backdrop.
Yeah, as the macro backdrop continues to look potentially weaker, how would you describe some of the resiliency that could be built into some of the subprime auto structures?
Yeah, well, as you mentioned earlier, the unemployment is still relatively low. Fitch's GEO contemplates really moderate increases. And then we take a conservative through the cycle rating approach. So we're conservatively deriving cumulative base case net loss proxies. There's also just some structural items, a relatively low weighted average life and building credit enhancement that increases as the transactions amortize.
Okay, Ian, let's go back to you on the broader consumer part of the market. How do you see differentiation on this in the UCL space?
Yeah, so UCL, unsecured consumer installment loans, is a different product than auto, and I think one of the main things that we're watching is how the increase in household balance sheet pressure, particularly for lower income, subprime, non-prime borrowers, is starting to be impacted, particularly given that we don't believe that these loans are high on a borrower's payment priority. So not like a car, certainly, or like a credit card where you have ongoing utility. These are loans for which purchases have already taken place, and so the ongoing utility for a household that's under pressure would remain challenged. And we've started to see that come out within the performance numbers, where we've seen originators that are focused on non-prime borrowers start to increase in delinquency and defaults, we've seen overall about a 2 times increase since the end of last year, third quarter 2021. So there is, I think, some newer originators which perhaps are getting kind of the modeling and understanding their customer base under them. But generally speaking, we think the pressure will be within that consumer segment, and that's where we've seen it thus far.
Yeah. Marketplace lending is sort of a unique subsector within that broader umbrella. How do you see, or how would you describe the evolution we've seen there in the last couple of years?
Sure. I would describe it overall as a maturing asset class. So we saw a number of originators come in like 2014-15 timeframe. That's given them a lot of time for performance history, but also their business models have changed pretty drastically. We've seen some originators that have now become banks. Other originators are increasing their financial services offerings, and I think overall there's a general sense of maturity. Now, during the pandemic, we don't consider that to be a credit crisis given the credit support that was provided, or the additional stimulus support that was provided by the government. But it was an operational stress where you had a lot more interaction with borrowers, increasing call volumes, and they were able to scale. So there are some positives that we've been able to notice coming out of the pandemic that show the maturity of certain originators. And typically, the higher prime, higher credit quality borrower, along with a longer business experience, is helpful for us when we're thinking also about AAA ratings. The last point that I would mention is some of the regulatory uncertainty. Well, that's still there. We have been monitoring court cases, which help us to have a better understanding on legal uncertainties like true lender.
Okay, great, great. I have one more for you. A day doesn't go by, it seems, where I don't read some headline in the news about student loan forgiveness. Can you talk about what that might mean for student loan ABS?
Yeah. Well, the biggest impact for student loan ABS, of course, will be in the FFELP portfolio, which is the legacy federal loans that are not held by the federal government, but are held by private investors. So they've never been included in the payment moratoriums, et cetera. And they have not been directly included, at least thus far, in student loan forgiveness. However, we're waiting for the Department of Education to give us additional guidance on whether they will be included or not. That will be coming sometime this year. And we will be watching that to see what the impact to ABS will be.
Okay, great. Margaret, let's take it home for us here. Battery electric vehicles, it seemed like there was a peak discussion in 2021 when we first started seeing fuel prices skyrocket. It's obviously here to stay. Can you share some color on where you think the battery electric vehicle market is going?
Yeah, I mean, despite the current administration's clear commitment to a faster EV timeline and environmental policy, OEM planning and investing clearly demonstrating commitment to electrification, the U.S. just still lags other markets. We don't have the same emissions requirements that we see in other areas of the globe. There are also just other headwinds about consumer adoption, so infrastructure, anxiety over charge time, battery range, that have it just hasn't been adopted at the level that we've seen elsewhere. So auto transactions that we're looking at still include single-digit concentrations, which are primarily hybrids still. So it just hasn't materialized in a meaningful way and affected auto ABS at this point, but we're going to continue to monitor.
Great. I want to thank you both for your participation on the panel today. It was enjoyable. And thank you for joining us. For more information on ABS, please visit fitchratings.com. If you have any questions on the topics we discussed, please send an email to the address on the screen. Thank you for watching.